Many retail investors stick to exchange-traded funds for their diversification and flexibility, but they don't offer much in terms of risk or exciting stocks at all. And if you're tired of Vanguard S&P 500 ETFs and the likes, here is one for you. Welcome back to another video and the second episode in the series where I cover all of the ETFs from ARK Invest. Make sure you hit the like button if you like the videos, subscribe to stay tuned for my next one. I post a video every Monday at 8 p.m. CEST or 2 p.m. EDT. So subscribe for more videos. There will be timestamps in the video description. Let's get going. ETFs is not my cup of tea, but if I had to pick some, I'd probably pick one of ARK Invest's ETF. Catherine D.Wood and her team over at ARK does great deep research on very exciting companies, and they create small but expensive ETFs with a very attractive risk-reward profile, in my opinion. And they cover sectors like 3D printing, fintech, automation, genomics, and a lot of exciting industries. ARKW or Next-Gen Internet ETF is ARK's main tech ETF, and it has companies from cloud computing, e-commerce, databases, and blockchain. And it holds companies like Tesla, Square, Tencent, Alibaba, 2U, Zillow, Facebook, Xilinx, and so on. And from their own websites, they try to find companies that will benefit from the shift of all infrastructure over to the cloud and the internet. And these companies will develop, produce, or enable cloud computing and cybersecurity, e-commerce, big data and artificial intelligence, mobile technology and Internet of Things, social platforms, and blockchain and peer-to-peer systems. So these are the areas that Catherine is focusing in on. So I think Catherine's idea with this ETF is finding small to medium-sized companies that's coming up with new ways of using the internet while also disrupting big industries. So, e-commerce, cash apps, workflow software, new social media, as well as blockchain is disrupting big old industries. So there are small companies coming in with new technology and software and growing really big because the industries that they're disrupting are already huge. Now, if you have a look at the top 10 holdings of these ETF, as well as their revenue growth and share return, we can see that they've been running really fast as of late. And although it might slow down for some of them, like Tesla, Square, Roku, and Facebook, these big companies, some of the smaller companies are yet to really get into investors' portfolios. So over time, they can actually accelerate. So the top 10 holdings are Tesla, does EVs and automation, Roku, which is a streaming bundling service and hardware, Square is payments and financing solutions, Huya is video game streaming, it's owned by Tencent actually, a Chinese company, Facebook, we all know Facebook, 2U Inc. is educational software, so software as a service business model. Zillow is an online real estate platform. LendingTree is a peer-to-peer loan platforms where people can apply for loans a lot easier than traditional ways. Sea Limited does video games and esports streaming mainly. They do a bunch of other stuff. This is a Singapore based company. And then we have Xilinx, which makes very complex semiconductors, SOCS and ACAP. Still a quite small company. So we can see the revenue growth has been everywhere from 30 to 900%. And the share return has been just about the equivalent. So they have had a lot of success, but I think the best years are still to come for these companies. Now, of these holdings, some of my favorites are Tesla, Square, Tencent, Xilinx, Alibaba, Amazon, and probably Adobe, as well as Nvidia. And as you can see, they've chosen a lot of software as a service businesses and apps and social media. And they have steered clear of some of the big names like Alphabet, Twitter, Apple, Oracle, and Microsoft. Because I don't think Catherine considers these companies the next generation of the internet as much as they are staples of the current age. So again, she's betting on the future, not looking at the current big players. Now, unlike most broad tech ETFs, this one holds mostly small to medium-sized companies, with the exception of Tesla, Facebook, Tencent, and so on. And the exact breakdown comes out to 28% mega cap, 50% large cap, and 18% small cap. But the large companies are what you can consider medium compared to the Nasdaq companies of the world. And the median market cap, so if you line up all the companies, the one in the middle will have about 31 billion, which is still quite small compared to Microsoft and Google and Oracle and so on. And like all the other ARK ETFs, it's a actively managed ETF, which means Catherine can buy and sell stocks as she sees fits. And she does rotate the portfolio quite a bit. For example, no holding can exceed 10% of the fund's value, meaning lately when Tesla has gone up hundreds and hundreds of percent, she's had to sell a lot of shares. Likewise, if it goes down, she might be buying. So this is an active, very much so actively traded fund. And the companies in this ETF are chosen on Catherine D.Wood's and ARK's own deep research, and it's not market weighted like most big ETFs. So Catherine allocates more money to the companies she believes in and the companies she thinks has the most potential upside. So it is quite different, and it is that comes down to Catherine's favorite companies. And I can assure you that ARK does brilliant research. You can see it in their podcasts, research papers, and YouTube channel that is open to the public, so you can actually go and see what kind of research they're doing. Now, the expense ratio of the fund is worth noticing because it's very high, 0.76%, meaning that you will pay that amount of your entire holding each year to ARK Invest, which will eat away at your profits, and the dollar amount you pay in fees will increase over time. So if you look at this example, if you invested $10,000 with no fee and $10,000 with the ARK Invest fee, after 10 years at 10% compound annual growth rate, the difference after 10 years will be 25,937 without fee and 24,056 with the fee, which is a difference of $1,880 over 10 years. And the dollar amount will, of course, just grow over time. So do keep the expense ratio in mind. But all in all, I don't think this expense ratio will slow down ARKW all that much. And I think the chance of the fund overperforming the S&P 500 by equivalent or more than the expense ratio is really, really high. I would put it at 70, maybe even 80% chance, just my personal opinion, that this fund will massively outperform the general market, justifying the expense ratio. And they're clearly betting on small up-and-coming companies. And although some might fail, if just some of them succeed, they will far outweigh the losers. And ARKW might be my personal favorite ETF, and it almost makes me tempted to buy in, but not for the time being. But if ARK Invest keeps this up, I might have to buy in at some point. So there you go, that's my quick little video on ARKW. I will do all the ETFs from ARK, so don't you worry. Let me know if there's any shareholders of this one out there. I know a couple of you have said you're invested. This one looks really attractive. Tech is definitely my forte and the kinds of companies that I like to invest in. And this ETF actually holds some of my holdings like Tesla and Nvidia. And although the ARKK is the flagship from ARK Invest, I don't really feel comfortable investing in genomics and fintech and 3D printing, stuff I don't know anything about. So I would probably stick with this one. So As always, thanks for watching, give me a topic for next video, and I'll see you in that one.